It's not fixed amount of money you can make like a cash secured put. If we remove this here and you see just on the wheel strategy, if you're doing a cash secured put, the most you can make is the premium that you receive. So if it jumps up more than the premium you received, $116, then you lose an opportunity cost, right? Because if you just outright bought the shares, then you would have made more. Turn it into a call spread instead of having unlimited to the upside, right? But if you think about it realistically, it's not going to go up unlimited in the next 39 days. So you pick what is realistic. And to me, realistic is like, let's say a 25 delta. 25 delta means it's a 25% chance it's going to expire above that delta on the call side, and it's a 50% chance it's going to touch that. So it's realistic. A coin flipping chance is going to touch this 22 strike, right? It's a little. I want everyone to understand the safeguard strategy, because here at Dorian Trade, we believe it's a better wheel strategy. It's better than the popular wheel strategy of selling a cash secured put, and then if you have to take ownership of the shares to sell a covered call, and then if your covered call is taken away or sold away, you come back and sell the cash secured put. That is the wheel strategy. The wheel strategy consists of two separate strategies that make up the wheel. Here at Dorian Trader, we call what we consider a better wheel the safeguard strategy, and it consists of four different strategies. Two of the four we're going to talk about right now, and that's the Bionic bull and the collar strategy. Now, what makes the Bionic bull a really awesome trade to do, and I'm just going to use this semiconductor ETF, this SOX L here for an example. You guys know we were in this trade maybe a week or so ago. We made some money, but obviously we would have made a lot more money on this if we would have held a little longer. But that's always, hindsight was always 2020. But it's still a great opportunity to potentially get into this ETF, because it is still significantly off its recent highs. So if we go here, and you can see, when I say recent highs, I mean within the last 12 months. You can see back here in July of last year, it hit 70. You can see that the 200-day moving average, which is this gold line, it's at just under 28 at 27.65. So it has a decent amount of upside it can still do, even after being up darn near 20%. I know it was up a little bit more than that earlier. But in this example, most people who have a large account or even a small account can be able to trade this, because it's not a high absolute dollar amount, but the implied volatility is worth trading it even if you have a small account. Okay. So in this example here, if I was going to do a Bionic bull on it, a Bionic bull is selling a cash secured put. And so let's just say we were okay with taking ownership at this 15 strike. It's selling a cash secured put, and then it's taking some of the premium, in this case 116, taking some of that 116 and buying a call. So let's just say I buy a call for anything less than 116. So if I bought this call for the 20 strike, in this example here, it's going to give me an overall 62 deltas to start with. It's dynamic, but initially it's going to be 62 deltas. So what that means is that it's going up 62 cents for every $1 move initially. This can change. You get the deltas from there and here, and that adds up to the type of deltas that you have, right? And you okay with taking ownership of the shares, so you'll have a cost basis about 14.74. That's the 26 cents that you're receiving minus the strike price. That would take you down to that 14.74. So if this went to zero, you would lose 14.74. We don't think this ETF is going to zero, so you don't have that risk, but you do obviously have the risk of it dropping to say $7 or something such as that. And so that's maybe realistically about a $700 of risk, but you have a lot of upside. If this can go back up to $70. I'm not saying it will right now, but if you plan this for a while, it could. That's 50 here. This is that strike. That strike price is 20. So plus 50 would be 70. So that's 50 points. So 50 times 100 is 5,000. That's the potentially to make 5,000 if it goes back to its all time, or at least the last 12 months highs. And so a Bionic bull gives you the ability to make money unlimitedly to the upside. It's not fixed amount of money you can make like a cash secured put. If we remove this here, and you see just on the wheel strategy, if you're doing a cash secured put, the most you can make is the premium that you receive. So if it jumps up more than the premium you received, $116, then you lose an opportunity cost, right? Because if you just outright bought the shares, then you would have made more. In this case, if you do this and you do the Bionic bull, you don't have that issue of having to worry about losing opportunity costs, because you will have the ability to make money into perpetuity within that time frame on that trade that you're doing. And you're not buying it at the money. So if we were going to buy the shares right now at the money, it would cost us just under 17 at 16.88. In this case, our cost basis is 14.74. So that gives us the ability for this to drop basically $2, and we still are up a little bit. So it gives you the ability for it to drop. That's basically dropping, giving back today, and you'll still be fine. Okay? If you're doing a Bionic bull, once again, if we go to this curve view, this is the at the money line here. If it goes up, you're going to win 100% of the time and have unlimited potential to the upside, as TastyTrade says here. This max profit is it's in unlimited. And then, but if it drops, you're still going to have a chance to win, right? You're going to still be able to win 60% of the time based on the probabilities that TastyTrade gives us on this platform. So this is the Bionic bull kind of strategy, kind of compared to the cash secured put. To me, this is definitely a better way to do it when things have been depressed, the overall market is depressed, your individual stock that you're looking at is depressed. You can get into it, and just in case your timing is wrong and it actually jumps up a ton, you'll be able to benefit it, right? So if you sold that cash secured put for, let's just say, a dollar on Friday, well, if you did the Bionic bull on Friday, you would have made a lot more money by doing the Bionic bull. The cash secured put is not bad, but sometimes the Bionic bull can be a lot better kind of strategic way to do the trade. Someone has a question?
Yes, quick question. If you were to move the call down to 19, it would cost you $5 or $6. Is that correct? If you move the call from 20 to 19?
Yeah, so
And would
it would go from a credit to a debit in the overall kind of trade. I would
would
rather
that
do
make sense to do, or would you never do that?
So I would rather do it for a credit, right? And so if I
Okay.
wanted to go to that 19, what I would do is what I call a modified Bionic bull. Turn it into a call spread instead of having unlimited to the upside, right? But if you think about it realistically, it's not going to go up unlimited in the next 39 days. So you pick what is realistic. And to me, realistic is like, let's say, a 25 delta. 25 delta means it's a 25% chance it's going to expire above that delta on the call side, and it's a 50% chance it's going to touch that. So it's realistic. A coin flipping chance is going to touch this 22 strike, right? It's a little less than that, but I just say this was a 25 delta. So in this example here, I still have a call spaces of 14.56, so it still has to drop more than $2. I'm collecting 45 cents, well, that's great, right? And so I can make 345 within the next 39 days. That's an awesome return on your capital. If you talk about that buying power that they have right here, that let's just say 1100, you say 346 divided by 1100, that is a return on your capital of 31.4%. So that's still a great return on your capital. If you wanted to get a little bit more and still get a credit, this is still a credit. You take it to the 23. The odds on it going to 23 is less than 50-50, but it can still do that, right? And so that's a modified. Sometime if you wanted to, and you're okay with taking on more shares, you can sell two. This is how Ernie, who created this strategy, kind of taught it most of the time and still teach it this way. You can do another put, sell another put here. Now you have this at the 19, right? And you have more, almost 100 deltas there, and you're okay with taking ownership of two here then. At that point, if you wanted to move this down a little further, you can, and you still get in a credit. Now you're down here, and your call spaces is the 2767. So if you take that, you have to divide it by two, because now you're gonna have two contracts. So your call spaces will be about around the 1383. That's will be your call spaces. So it's still below 14, which is great, right? If you're okay with taking 200 shares. So some ways you can do this trade to make it work for you, right? So for example, in here on this account here, we have a Bionic bull that we just put on just a second ago, as you guys can see here. This is, and I should have put it in Discord. I got to remember to put these things in Discord. So anyway, I just put it on earlier today, and it's a modified Bionic bull. This is the selling of the put. This is the buying of the call. This is the selling of the call. So you're selling a call spread, and you're doing it for an overall credit. So got $50. That's pretty good in 11 days, right? To collect $50. If it does nothing, you still win $50. And then we have some other Bionic bulls in this area here. So this is a Bionic bull that we've had on for a second. We sold the put at the 47 strike, bought a call at the 55 strike, and that's now in the money, right? It's in the money by $10, and we still got unlimited potential for the next 18 days. So these Bionic bulls are great, and they can really work with the upside. If we just sold a put, there's no way we would have had the ability to make as much as we are making already on that Bionic bull, or the potential to make as it continues to go up, right? So all right, so let's move on, and let's now compare the Bionic bull to the collar strategy using that same underlining that we were looking at, this Oxale here. And so if I go here and I do a collar strategy, and a collar strategy is when you do a cover call strategy, then you sell a put based on how much you're receiving. Excuse me, you sell a call because you're doing the cover call strategy, and based on what you receive for that call, you buy a put, I should say. So in this example, let's do a wide collar, and let's go to this 23, right? So it's about a 50% chance, just under, but I just rounded up and say it's a 50% chance it's going to touch this 22 in the next 39 days. So we're collecting about $57. So we want to buy something. We want to buy a put for less than $57. So, and if we went down here and bought this put at 11 strike, well, that's still going to give us $29 in a credit, with the potential to make as much as 22 to the upside. But the most we can lose in this time frame is 580. And if it drops a lot, that's going to be the most we can lose as we hold the trade, because we can continue to adjust this put on this collar strategy. But this is a wide collar, protecting you to the downside some, and allowing you to still have some upside. And if you wanted to make that less to the downside, as I say, you wanted to go all the way to this 14, and you can see, but this is going to be a debit then. I don't want to do this for a debit. So if I move this up to the 21, that's still going to be a debit. If I move it up to the 20, then it's not going to be a debit anymore. So now you just set this up for the next 39 days, basically risk one to make one here. You can make up to $306, you can lose up to 294, but it's got a very high probability it's going to touch this 20 strike, right? Because it's a 34 delta, probably it touches 2 times delta. So it's a 68% chance it's going to touch. More likely than not, it's going to touch this 20 strike, but it's only a 34% chance it's going to expire. Markets go up and down, even underlyings. So selling this 20 strike is good. If it jumps up, that's fine. You're still going to make $300 off your 1268. That's about 30% return on your capital in 39 days. That's really good. If you wanted to do more than one contract, you could, but you always want to stay small when you're doing these things, right? But I like this. It works for a small account. Even if you only had a $2,000 account, you can see that you're only risking, you're risking less than 20% of your account if you had a $2,000 account, or you're risking a tiny fraction of your account size when you have an account like that, less than 20% of your account, and you still get to have a potential to make a lot off your 2000. So I like this. It's a lot of kind of stocks out there, and maybe I shouldn't say a lot, but it's a number of them that's trading at lower dollar amounts that you can benefit from. This one's great because the options are robust and it has a lot of implied volatility in it, even as volatility kind of came out of the market today, as you guys can see. So this is
Deal, Brian.
a collar strategy that I love. And when things have jumped up, one second, Ron, when things jump up a ton, this is where I want to do. If things are near or at all-time highs, this is the type of collar strategy I would like to do.